Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Hello and welcome to the show. This is Andy Webb with Lifestyles Unlimited. And as always, we are working on your financial freedom. And I think in the coming year and a half or so, you're going to find that financial freedom, that income from residential real estate is going to be extremely important. Why? Inflation. Ask yourself, have you been noticing, have you been feeling the bite in your wallet from said inflation? I have. Noticing that maybe your dollar is not going quite as far at the gas pump maybe, or at the grocery store, pretty much everywhere these days. And I want to get a little bit into inflation with you today. We got the latest news. The September numbers are out. A lot of very interesting numbers, in fact, across the board are out. We're going to take a look at those. There is some interplay there. The quits rate, for example, 4.3 million people quit their jobs voluntarily in August. That's the latest JOLTS report that's come out. How does that play into inflation, or does it? And when we think about wage inflation, is that for you, the real estate investor, is that a good thing or a bad thing? Inflation sounds like a bad thing altogether, but we'll talk about that. Now, what are they saying? The Fed boss, I don't know if you saw this article recently, Jerome Powell, he came out and, among other things, said that he is frustrated with inflation. He's frustrated. Which, to go back to you and to me in our pocketbooks, how about you? I know I am. We got back from our 4-week RV trip to the East Coast a week or so ago. One of the first things we did is go out to one of the big wholesale stores, wholesale clubs, where we'll stock up on mass products. And I was a little bit floored because my favorite coffee, I just get the house brand, nothing special. In the time we were gone, the price had accelerated 20%. It was up 20%. I kid you not. I went a different direction. I said, I'm not paying that. Found a replacement good, but you can't always do that. Diesel, I drive a diesel truck to pull that RV. In the time we were gone, it's gone up easily 20, 30 cents here in the area. And diesel's not nearly as fluid as gas prices tend to be, I see. That's price inflation, and on top of that, you may have noticed this as well. There's a little bit of sneaky inflation out there, that's my term for it. You've probably noticed this in the size of your cans of tuna fish lately, or more recently, having a conversation with my father-in-law. We're planning a birthday party for my wife's grandmother. She's going to be 90. And my father-in-law went to the store to pick up some of those packs of Hawaiian rolls, and he was telling me, relating this to me independently afterwards, something just didn't look right. And he finally figured it out. They're normally 30 to a pack. Well, his package had 24. Price was the same. So whether they're actually raising the price or diminishing the quantity of goods in that package, we're seeing that inflation. We've also seen it. Social Security. Did you hear this? They have adjusted the cost of living. It made the annual cost of living adjustment for 2022. It is the largest jump in 40 years. But hey, what inflation? Again, JOLTS, I mentioned that's the Job Openings and Labor Turnover Survey, where the Bureau of Labor Statistics, they look at what's happening in the market. I already mentioned that quits rate, 4.3 million. That is 2.9% of the workforce that voluntarily left just in the month of August, and that's been going on for months now. We have seen progressively higher and higher record quits rates. Do you wish you could be in that number? And more importantly, how could that, again, I touched on this, how could that huge quits rate turn into more inflation than for you and for me? Stay tuned. It's coming. It absolutely is. So to start with inflation, we're going to hit that, and I want to get a little bit more into that quits rate towards the end of the show. I actually learned about this term from one of our other radio hosts. Mike Harrison did a show a few weeks ago, September 19th. You can find that if you go to our website, lifestylesunlimited.com. That podcast is archived there, but he went into the term the Great Resignation. And if time permits, after we get through the inflation, I want to go into some inflation hedges with you as well. Real estate certainly is one. I have a list of 9. We're just going to touch on those very briefly. And I think you'll see that owning a single-family rental property or being invested in multifamily is truly the way to go. In fact, I went to the multifamily road trip here in Dallas-Fort Worth just this past Friday, and as part of those road trips, vendors will get up and they'll give us the latest and greatest on the market. And one of those vendors that spoke was one of our lenders, and he went into the numbers, and we touched a little bit on inflation, on wages, and why that is important, and how that then plays into real estate for you and for me as, I think, the perfect real estate hedge. But let's start again with inflation, because that is the foundation of the discussion here today. So the latest news was for September, the month of September. The report recently came out about a week ago, and inflation it's climbed again from August to September. It's gone up a little bit, and it's now at a 13-year high of 5.4%. Now, that's measured year on year. So if you compare prices now to September a year ago, 2020, those are up 5.4%. That's the broader index. On top of that, if you dig a little deeper, you're going to find producer prices have also risen at the fastest annual pace on record here for the 6th month in a row. So again, they just keep going up and up and up. In this case, they hit 8.6% annually, so year on year in September. Now, that 8.6%, we're not seeing that yet in our consumer prices. These are the producer prices, and that surely relates in part to the backlog, the congestion that we're seeing at the ports, the supply chain disruptions, and everything else that has resulted from COVID and everybody laying down their hammers for a period of time. But that will, in the months to come, then translate into consumer inflation for you and for me as well. So are we going to stop at 5.4% as we saw in September? Will we get the October report and it is now 6%? Will we get the November report? It's a little high. I don't know. I don't have my crystal ball dusted off quite yet. But we are going to look a little bit more at inflation and get into those inflation hedges when we come back. And we'll answer that question as well. Is there an upside to that wage inflation we're going to talk about? So stay tuned.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. I'm your host, Andy Webb. If you have any questions today, the number here in the studio is 855-497-4335. Again, 855-497-4335. Or send me an email to askandy@luinc.com. Again, askandy@luinc.com. So we're taking a look today at inflation. A week or so ago, the latest number came out for September of this year, and it peaked again over the prior month at 5.4% year-on-year inflation, September 2021 to the prior year. And I don't know about you, but I'm noticing this when I go grocery shopping, when I fuel up my truck or the car, diesel or gas, doesn't matter. When I start to listen to what they're projecting I just had to turn my furnace on for the first time this morning. It was cold. And my son woke up, put his very frigid hands on me. I said, all right, we're cranking on that heater. Well, I don't know if you've heard, but natural gas, they're anticipating a 60% increase this year for heating fuel. Now, some of that, again, it will be supply side driven. We've seen a lot of disruption to supply. Does that make that less of a sticky type of inflation, meaning that sticks around, that's going to last, that doesn't recede after a period of time when those supply chain disruptions are corrected? I suspect with the gas, that's going to fluctuate a lot. That's a commodity. We're going to learn here in just a second. Commodities are one of those inflation hedges that you might want in your portfolio, or maybe not. Maybe not. I think real estate's the even better way to go. We'll get to that, though. Let's talk a little bit more about what we're seeing, though, in terms of inflation. So the announcement was 5.4% for the consumer inflation. Producer prices, as I mentioned, again, rose at the fastest annual pace on record for the 6th month in a row, meaning it just keeps getting higher and higher. That's at 8.6% again for September. In the long run, that will translate into higher consumer inflation for us as well. But here again, the question is, A lot of that is, as I mentioned, driven by supply side disruptions, just with the logistics, just with the backup in the ports that we've seen in Los Angeles and getting out of the ports in China. And with some of the worker shortages over there and across the board. But the question becomes, how much of that inflation will be that very sticky inflation that we mentioned and not transitory, as the Federal Reserve, as Jerome Powell keeps trying to sell us? Again, he just recently said, this is in an article on CNBC.com, Jerome Powell, the central bank head here in the U.S., said that current inflation pressures are, quote, frustrating. And I think he's frustrated from a job perspective, but I'm sure that you and I are frustrated from other points of view. And as the Federal Reserve, measures inflation, it's running at its hottest pace in 30 years. Transitory or not, it's here. Now, he does say, I think there's a silver lining here in the article. He goes on to say that 2022 should be, quote, quite a strong year for economic growth. I certainly welcome that. And of course, with economic growth, we do tend to see an uptick in inflation as well. Now, moving on, another place I went to look is at one of my regional banks here in Texas, Comerica Bank. And now their economists, on the other hand, they have lowered expectations for GDP growth. And then they as well are now forecasting higher inflation rates for 2022. Right now, they've dialed it up. So formerly in one of their prior reports, they projected 3.6% for inflation in 2022. They've taken that up almost 100 basis points to 4.5%. So they're expecting that to stick around. They say, in fact, while some components of inflation may indeed revert from recent hot levels, we believe that other components are sticky. And that includes things like rents. That kind of comes full circle back to you and to me if you are, like me, a rental owner. But the sticky components include rents, wages, and of course, many supplier contracts. Once you enter into a contract for 1, 2, 3 years, well, that becomes sticky at that point. So dovetailing off of that, let's talk a little bit about that wage inflation. We talked just a smidge about the quits rate. Another article here, this was on Bloomberg. Goldman Sachs, the CEO, says wage inflation is spreading through the economy. And this is important for you to understand for two reasons. And we'll get to those two reasons here in just a minute. But the CEO, David Solomon, this is at Goldman Sachs, he said that inflation, particularly in wages, remains top of mind among corporate leaders and shareholders. Rightfully so. That, as we just heard from Comerica, is one of those sticky parts of inflation. Once you think about it, once you offer somebody a contract or raise their salary, you don't typically go and then drop it. If you do, what's going to happen to that quits rate? It's probably going to go up even more. Then Goldman President John Moynihan goes on to say that recent inflation driven in part by worker shortages, see the quits rate, and rising wages is clearly not temporary. So again, my thesis here is that the transitory inflation that we keep hearing about, some parts of what we're seeing in that CPI basket will recede. They will go back to earlier levels, perhaps. That may be the natural gas prices. That may be things that fluctuate a little bit more. But good portions of that basket are not transitory. They are sticky. And again, going back to that quits rate, 4.3 million people voluntarily left their jobs in August. Again, Mike Harrison did a show on this very topic on the Great Resignation mid-September. If you go to lifestylesunlimited.com, I don't want to go into all the details he gave there, but he was talking, this was an earlier point in time, and already then we'd seen the quits rate at huge numbers. People are feeling very confident, and they're out there. They're quitting for a variety of reasons, among others, better wages, better pay. And I don't know about you, when I drive around my town, or even as we drove east to Washington, D.C. with the RV and came back, everywhere we stopped, we saw hiring signs. People are desperate right now. Employers, small employers in particular, are desperate for employees. We went out to lunch yesterday to celebrate our anniversary, my wedding anniversary, and there was one guy operating as the server in a big room. I'd say about 15 tables were occupied. One staff, one waiter. That was it. He said, are you it? He said, yeah, I'm it. So please be patient with me. No problem. We'll be patient. We'll tip you accordingly, of course, as well. But employers are getting desperate. And what are they going to do? They're going to start to offer those higher wages. So that wage inflation spiral it has begun. It has begun. So get ready for that. Last point I want to make on inflation is, and I hinted at this at the start as well, look at Social Security for a clue. When they tell you it's transitory, or it's not quite there. Look at Social Security. What have they done? We just heard that the cost of living adjustment for Social Security for 2022 is 5.9%. 5.9%. That closely mirrors the inflation rate we just heard for September, doesn't it? That is the largest jump in 40 years. 40 years. So isn't the government implicitly acknowledging inflation right there? Separate question, by the way, before we head into the break. Ask yourself, if they're paying out more, 5.9% more, what is that going to do to the Social Security Trust Fund if you're planning on relying on that at retirement? Projected insolvency mid-2030s? Hey, that may accelerate. So stick around.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
And we're talking today about a hot topic. It's in a lot of the news broadcasts. You'll see it in the press. It's inflation, and it is here. And they've been trying to sell us, give us a bill of goods saying, hey, it's transitory. But the deeper I dig, the more I read, there are clearly components of that inflation that are sticky, meaning they're not going away. Once that inflation occurs, you're going to hit a price point and you're going to be staying right there. That may not be gasoline. That may not be diesel. That may not be food costs. Although when I talked to my father-in-law and the volume of rolls in his Hawaiian rolls was no longer 30 rolls, but 24. That's clearly not going to change. Price may be the same, but you're getting a little less for your dollar there too, aren't you? So we're seeing it in different places and in different ways. And we talked in the first segment or so about what those numbers look like. If you missed any part of the show, you can go to lifestylesunlimited.com, go to the podcast, and we do archive the programs there. But you can go check out just do a search for inflation and you'll see the numbers and they are up. They are up. Social Security adjustment, COLA, cost of living adjustment for 2022, 5.9%, the largest increase in 40 years. That alone points to inflation. Inflation rate for September, 5.4. By the way, within that 5.4%, just the food component of that increase, that was 4.6% year on year. So if you're used to spending $100 in one go at the grocery store, it's now $105. And could that keep going up? Yes, it could. Now, what do you do to protect yourself? How do you hedge? How do you hedge against inflation? And we're going to look at a couple of asset classes just in brief that you can use to help you. A lot of these are commonly known. Gold, for example, you hear it all the time. I hear it on the radio, people selling gold as the classic inflation hedge. And it is the classic inflation hedge. Is it the ideal inflation hedge? Not really. I'll tell you why. But I have here a list of nine asset classes or 9 assets that you can use to protect against inflation. This is on Investopedia if you want to go find this article. It was updated recently, May of 2021. This is something that isn't going to change much. They have gold on here. They have commodities. Number 2, they have a 60-40 stock bond portfolio. Hey, right now stocks are performing wonderfully, aren't they? Bonds, not so well. REITs, that's a real estate investment trust. A very, 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 very passive way, perhaps, to get into what we do as real estate investors. S&P 500, again, that's essentially stocks and bonds. Stocks, anyhow. Number 6 on the list, we finally get to real estate income. And I think that's a key word right there. In fact, I have my list in front of me, and I am underlining that word income. Number 7, aggregate bond index. Number 8, leveraged loans. Very, very high risk, by the way. Leveraged loans, you are lending to a company that is already in dangerous territory. They are deeply in need of money. So it's very high risk. You may get a great return if you get your money back. And then tips. Here's the thing. If you look down this list, and I underscored on number 6, real estate income. If I just start with number 1, gold. The beauty of gold, aside from the fact that it's gold and it's shiny, and some of you may like to wear that on your fingers or on your ears, is that the value can go up. It's a scarce resource. And as people dive into that because they are in fact afraid of inflation, that does push the price up. So gold will tend to move in value with inflation. Here's the big problem with gold, and here's why I underlined that third word on number 6, real estate income. Does gold present you with income every month or every quarter? It does not unless you sell that very gold that you're sitting on, and that is the problem. That is the same problem that we see when you pile your money into your 401k or IRA with the target of retiring at 67 or 65 or whatever your number is. You're building a mound of value, but that value does not cash flow. That value has to be drawn down in order for you to live off of that value, and the same is true of gold. The same is true of commodities. I can invest in those commodities or into futures, but until I sell that piece of paper that represents that commodity, whatever it is, I do not get my income. Same with a stock portfolio. Same with the S&P 500. Now, the bond portion, sure, they may throw some dividends your way from time to time, but bonds have not been doing terribly well either of late. So none of these really, maybe the REITs give you a little bit of income, but none of these was I able to underline that very word income, and that is the key thing. That is the key thing with let's talk about why real estate now in this context, because it does many more things. Now, real estate, just like gold, when we see inflation, when we see values inflate around us, just like gold, real estate does the same thing. And if you're like me, we've been seeing that massively for the past decade. Values just keep going up and up and up. So the value will increase. But again, if you think from a gold perspective, that doesn't help me until I sell or do a cash out refinance on my rental property, perhaps. But alongside that, you have to remember we're making money 5 different ways with our real estate. And cash flow is one of those. So there is, in fact, income. And it gets better than that, because if you're doing this right, if you follow the Lifestyles model, let's talk about single-family houses. That's what I've been doing for 9.5 years. We're in multifamily now as well. But from the single-family perspective, what do? We buy a house that's a wreck. We get it at a discount. And because of that, we have equity capture from the outset. That is money on my balance sheet. That's value that I've essentially forced through the process. Now, I can't tap that until I sell or refi, but it's wealth. But we fix the property up. We put a resident in there, and now we have rental income. And from that rental income, we pay the mortgage every month. And as part of that mortgage, we're paying down the principal. That's equity buildup that's happening in the background. But here's the thing. When we've gotten to that point where we've fixed up the house, we've gotten into a then 30-year fixed rate loan. That's what you need to target, ideally. If you have the debt to income, if you have the W-2 job to support that as you build that business, eventually you'll get out of that W-2 job. But you want to get that cheap Fannie Mae, Freddie Mac, fixed rate, 30-year debt on that property. We did a cash out refi, probably been about 1.5 years now. Our 30-year mortgage note on that is under 3%. 2.75, I think, is what it was. So that means as inflation comes creeping around the corner and starts to eat away at my pocketbook, I have a fixed rate note on that property. It's not going to change. What will change is the value of that property. And more importantly, rents. We just heard rents are up. Rents are sticky. Inflation, by the way. And as rents increase, the spread between that fixed rate debt and my rent goes up. I wind up making more thanks to inflation than less. But you're thinking, yeah, but other costs are going up as well. And that's true. We've seen an increase in property taxes. We've seen an increase in insurance and an increase in supplies and materials and labor. But going back to that multifamily road trip I went to on Friday, the lender that was speaking touched on this very topic, and he pulled a report from Yardi, I think it was. Rents are up 11.4% in September, year on year. 11.4%. Bottom line, rents are accelerating faster than our bottom line costs. So I've got fixed rate mortgage in place. That doesn't change. Sure, my insurance, my property taxes may go up. Now I'm going to protest those and keep them down as best I can. Other costs may go up as well if I have any maintenance. But the rents are accelerating at an even faster rate. This is true on single family, and this is true on multifamily as well. So that rent growth is outpacing the expense side of inflation. So we're just simply seeing a bigger spread. And going back to the question, that quits rate, which is going to drive that wage spiral, that wage inflation spiral, is that bad for us then? Well, guess what? As you start to get a higher wage, you can now afford a higher rent. That makes me feel a little bit better when I go to renewal season and take that rent up. $20, $30, $40, $50, $100. What does the market bear? We're going to look at that. Hey, stick around. We're going to come back to the very question about uncomfortable inflation and your mindset. Stay tuned.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the show. I'm your host, Andy Webb. If you have any questions, you can email me anytime to askandy@luinc.com. And so far today, we've been talking about inflation. And in the course of the conversation, the last segment, I mentioned that real estate, we looked at just very broadly, commonly quoted assets that you can have in your portfolio for protection against inflation. And the big problem with pretty much every single one of those, yes, their values may go up alongside inflation, and that's great until you need the money that's underlying that value. What do you have to do? You have to dispose of. You have to sell that very asset. Then your asset, your portfolio has now declined. That's what you have to do to get to the cash. Real estate, however, rental real estate gets that value growth alongside inflation. Oh, and by the way, it cash flows as well if you're doing it right. And I hinted at some of the ways that we make money through our real estate. I don't plan to go into all 5 of those today. That's 5 on single family, actually 6 ways with apartments. Best place for you to go to learn more, aside from maybe some of our earlier shows, you can go to lifestylesunlimited.com to catch those. Those are archived there. But go check out our free workshop. If you're new to Lifestyles Unlimited, if you don't know who we are, if you're catching the show for the first time, maybe you've been listening for a while but haven't taken that next step, that is the free workshop. You'll learn about Lifestyles. What we are is an education and mentoring group. We take you, we hold you by the hand, we help educate you on becoming a real estate investor, whether that's single family or, yes, a multifamily. You can be an apartment investor. We have thousands of members that have retired themselves on both tracks. But you can learn more if you go check out that free workshop. You can go to our website again, lifestylesunlimited.com, or just type freeworkshoplivestream.com. It's an hour and a half. It's free. It's done online, so you can do that from the comfort of your home, either in the evening or we have some midday sessions as well. Years ago when I joined, my wife and I, we went to the free workshop as our starting point after listening to this very radio program for far too long. And that was live and that was in person. But since COVID, we've shifted this, and it's very convenient. It's very easy for you to do that from the comfort of your home. So check it out again, freeworkshoplivestream.com. You'll learn about those 5 ways we make money, and you'll start to see, you'll get some numbers, in fact, around how a single family house works cash flow wise, multifamily, and why they make, in this case, a good inflation hedge. Now, they're not going to get into inflation per se. And to be honest with you, when we joined as members 9.5 years ago and went down that single family track, inflation was not on my mind. I was not buying my single family houses because I was thinking about inflation hedges. But in hindsight, and seeing what's happening in the market right now, and seeing the inflation of costs around us, and seeing my rents go up to more than absorb that inflation, I'm very, very glad that we got into it. Again, that's hindsight. We got into it for other reasons, namely the cash flow to retire my wife, which we did in about 3 years. From a terrible job, but she was part of that quits rate years ago, and I'm very happy about that. But the point is, this is just another benefit. The benefits to investing in single family and multifamily income producing real estate are tremendous. The mindset shifts. I had an interview a few weeks ago with a multifamily investor out of Atlanta, and he just and I loved when he said this. He's just more hopeful. The future was looking a little grim. But since he's become an investor, gotten into some into some deals as a passive, meaning he's not leading the project, he's just put his money into the pool, and now he's a lead investor himself, meaning he's syndicating those multifamily deals. He's become more hopeful, and I want that for you as well. And the fact that real estate makes such a tremendous inflation hedge, that's just part of the picture. But that's the picture we're focused on today because so much news has come out lately. Again, Social Security cost of living adjustment, 5.9%, the largest increase in 40 years. That points to inflation, even though they don't want you to think about inflation. It's transitory. But it's not. And we heard about the wage inflation spiral. I want to take just a quick look at a headline here. This was in the Washington Post. This was mid-October. Uncomfortable inflation is here, they say. Uncomfortable. Jerome Powell, he's frustrated. By the way, I bet you are too. Uncomfortable inflation is here, and it's changing the economy. I'm going to come back to one of their opening lines here as a transition, but if I fast forward a little bit here, they talk about rising food, gas, and rent costs. They're hitting the budgets, your budget, my budget, of low and middle income Americans very hard, while wages have been rising at the fastest pace in decades. The gains, unfortunately, have been eaten up entirely by rising costs. Okay, this is what the Labor Department data is showing. By the way, I mentioned one of those pieces of the core inflation earlier. That's food, up 4.6%. My wife happened to, I guess she's listening to the show, tagged me on social media. Gasoline, up 42.1% year on year. Energy, that's your electricity, 24.8%. Fuel oil, that's our heating oil, 42.6%. Used vehicles, 24.4%. Clothing, 3.4%. Transportation, 4.4%. All of that is chiseling away, is eating away at the dollar in your wallet. Now, if you have a counterbalance to that, which again is the cash flow coming out of your real estate, which can be inflation adjusted, as we've talked about, then that will help you out tremendously. Now, going back to the very first piece of this article, again, this was in the Washington Post. They get into a lot of data, a lot of numbers around that very thing that I just mentioned, the sundry components that are increasing, but uncomfortable inflation is here. It's changing the economy. I like the last sentence in the very first paragraph, and they talk about that the important thing, or the biggest thing with inflation right now, it's not the fact that we've got these ships stuck in the port outside of Los Angeles. It's not the fact that the food prices are increasing. It's what's happening in Americans' own minds. What's happening in your mind as your expectation shifts about the cost of those goods. As you start to accept that, you're starting to go through a mindset shift. Oh, well, I went out to eat yesterday. It just cost a couple more bucks. Oh, well, gas is a little bit higher. I'll work a little longer. I'll do a couple more hours at the job to figure out how to cover that cost. You're starting to undergo a mindset shift, but I think it's in the wrong direction. It's the wrong kind of mindset shift. When we become members at Lifestyles Unlimited, a lot of what we focus on very early on, and you'll hear this at the free workshop, is mindset shift, but not into accepting the situation that is around us right now in the case of inflation. Here's one last article. I'm just going to quote the headline here for you. And this was also on CNBC. They say, the great reimagining of work, why 50% of workers want to make a career change. Again, I want to go back and mention the show that Mike Harrison did on the 19th of September, The Great Resignation. He got into a lot more data, a lot more information about that very thing that's happening. People are quitting in tremendous numbers, 4.3 million in August. That's come out since Mike has done his show. I think we're going to continue to see this. And I think the Great Resignation, as Mike talks about on his show, dovetails with this article and what they're calling the Great Reimagination of Work. That there is a mindset shift as well. And here too, it goes into too many details, too much data for me to mention here, but I think one of the interesting points, it says of the roughly 50% of employed Americans who intend to make career changes, some will be changing to get those higher wages, by the way, 22% said they're going to quit their current job and start their own business. That's essentially what my wife and I did in 2012, when we became members at Lifestyles Unlimited. We began to build a residential real estate investing business. That's what 50,000 members at Lifestyles Unlimited have done. Now, we didn't quit our jobs first. As I mentioned earlier, we needed that W-2 income to secure those Fannie Mae and Freddie Mac backed loans, that cheap money, right? So you want to keep working as you build that portfolio, but we effectively put that business into place first so that we could then retire. But the bigger point here I want to make is that people are starting to think about things differently. And if it's inflation, yes, it's there. Acknowledge it, be aware, do something about it. And I don't mean buy less. I don't mean scrimp and save. I don't mean work extra hours to get that overtime. I mean put something into place that means you don't have to worry about that inflation quite as much. Talking about putting into place that single-family portfolio. It starts with one house, and then another, until you've built up that cash flow, and that's meeting your expenses every month. And hey, if inflation occurs, your rents are going to go up. You're going to absorb that inflation. You've got the perfect hedge. It's not gold. Gold doesn't cash flow. It's not commodities. Commodities don't cash flow. We want that cash flow. That is pivotal. So that when I see that the year-on-year increase in clothing costs is 3.4%, well, I'm more than covering that increase in my adjusted rents for the year. So you need to think about that. Don't adjust your mindset, as one article said, towards accepting inflation. Rather, adjust your mindset and start thinking about putting things into play like we did 9 years ago to create that income, to put that inflation hedge into place so you don't have to worry about this quite as much. All right, again, go check out Mike's show. That was September 19th. I do thank you for listening today. A lot of information. If you missed anything, you can go to lifestylesunlimited.com. The shows are archived there. And again, while you're there, sign up for that free workshop. Start that movement down that path. It starts with the first step, and before you know it, you'll have momentum, and you'll have that portfolio in place to become real estate retired, to not worry about inflation, and to live the life that you've been dreaming about. So again, thank you for listening. You've been listening to the Lifestyles Unlimited Real Estate Investor Radio Show. Remember, it's not the money, it's the lifestyle. You have a good day.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.